Hello and welcome. You're tuned in to CNBC TV 18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, cryptos and currencies. Today, the focus is on the base metal prices, which seem to be hitting multi-month and multi-year highs. When you look at copper, not too far away from its all-time highs, you have zinc trading at a 10-month highs, aluminum at a strong 3-year highs, and then there are strong gains coming back in case of zinc as well, and tin rather, which has seen nearly 25% of gains come in. Let's put all of that in light with Kunal Shah of Nirmal. Kunal, hi, thank you so much for joining in. And I want to start with copper first because the best of the gains clearly seem to be coming in for this one. And the most bullish of cues and most bullish of forecasts also are in case of copper. While, of course, the macros seem quite supportive, whether it is about the dollar index down by nearly 7% in this year, or the international debt and the fact that you're looking at something tangible to pass your money on. But when it comes to supply concerns, how are you reading with that?
I think we have been very bullish on the complex from last 3.5 months, and we continue to remain bullish going forward also. The macro backdrop is fresh rounds of liquidity expected to come from Fed, ECB, even Bank of Japan is on likely to be on the easing path. Uh, Fed stopping quantitative tightening, that itself is a very big relief for the market, and that shall lead to good demand going forward in industrial metals from US also. And I believe that from here prices can move up by another 20 to 25% as far as copper is concerned. 12,500, $12,800 would be my target for copper. And on LME India, that should translate into somewhere between 1150 to $1,200, 1,200 rupees per kg on MCX. Aluminum still looks very attractive. We came to know yesterday Rio Tinto is one of the big aluminum smelter is closing down the operations. That itself is very bullish. Uh, I'm pretty optimistic about the outlook of in industrial metals, and my bullish bets would be copper, followed by aluminum, then followed to zinc. Another 10 to 15% upside in aluminum and 10 to 15% upside in zinc can't be ruled out from here.
Coming on copper slightly more because, the China plenary meeting rather suggests that they want to look inwards more, push domestic consumption higher, not so much in case of exports. And China has been working quite strongly with rare earth metals itself. And their plan clearly has been changing in last few months, years for that matter. What is it that you sense in sense of China's copper consumption going forward?
So as far as China's copper consumption is concerned, 13.5 million ton is the total Chinese demand. And going forward, even if this demand grows at 1.5 to 2%, in fact, 1.5 to 2% growth will be very big number going forward for copper Chinese growth. So even if it comes up with a 2% demand growth, we are going to have another, 2.5, 3 lakh tons of copper demand in China in a market which is already pretty tight. The smelting capacity is likely to get shut in China. And I again, I talk about it in your show that China is likely to follow the involution policy. And under the involution policy, they are going to cut the excess capacities in the refined markets, all the smelting excess capacity in case of copper, in case of aluminum, is likely to get waved off by them, and that is also very bullish for these industrial, because the concentrate market is very, very tight. So you see the quotes which are coming from Latin American, South American countries for copper, it's already in premium. So I believe that this bull run has started, and copper is likely to give you much better returns the way precious metal gave you this year. 2026 is the year of base metals.
All right. 2026 is the year of base metal prices. For copper as well, China is one part of it, Kunal, and the US and China trade talks that we are hearing. If that does go through, is that more bullish for copper again?
Sentimentally, yes, but even if it doesn't goes well, it's still bullish. Because let us say the other scenario, that if the talks doesn't go well and US imposes big tariff on China, then China will no doubt buy and start stocking commodities left, right, center, because they don't want to keep a US dollar then in their treasury. So if US, they try to come up with another round of tariff or sanctions, something like that, then I think it's going to be very bullish for. And if there are no tariff or the tariff are scaled back, in that scenario, the manufacturing demand, the export demand should rise of industrial goods, and that shall lead to higher prices of copper. So it's a win-win scenario, no matter which side US policy go from here. The outlook for copper is very clear. That is bullish.
Mm. And usually as the scenario is, Kunal, I take your point when you say that 2026 is going to be the year of metals. Every cycle does come back with its profit takings, ebbs and outs really. There are expectations again that by 2027, 28 perhaps we will look at supply increasing. But then there is that BHP report as well suggesting that there's going to be a 50% increase in copper demand by 2050. So I'm assuming it's a one-way, not perhaps linear, but higher highs and more growth that we would see in copper prices eventually going forward. But with its highs and lows, with the sense that higher prices would lead to higher supplies?
I think supply side, again, when you talk about supply, you have to talk about the concentrate market. So when the old mines are getting exhausted and the old's quality is getting depleted, from where the new mines are going to come and make up for it, until copper prices reach to $13,000, $14,000, then I think the miners will ramp up the production. But even if they want to ramp up, where are the new mines? So I think all these industrial metal markets are very tight, and in a scenario where the demand side, if it improves, I think the quantum of jump will be pretty big, because it takes time for supply to really realign to the prices. And I believe that there is no possibility of excess concentrate supply. So the overall, I don't think so. It's not going to help much. New supplies will be very slow, and it will not be in a big number. So I've seen the 2026 expectation of hike in copper production. It's merely 4.5 lakh, 5 lakh tons. That's not enough. So we need more copper, and the demand side is getting strong traction. So I don't think so. At least for next 1.5, 2 year, this bull run is likely to stay.
Mm. Well, that's about copper. Let's talk about aluminum. And what really bothers aluminum production is the electricity of, supply therein. And that is what we seem to be looking at in some countries therein. What are the supply concerns that you would see in aluminum from here on?
So when you talk about aluminum, it's China versus ex-China. So China has put a cap that they are not going to produce. I think their cap is 46 million tons, and they're not going to produce anything above that cap. So China is just near that cap. So from here, the Chinese production is definitely going down rather than going up. Coming to the US part, US, because of the AI boom, the electricity demand is soaring like anything, and we all know that aluminum is very power intensifying metal. You need a lot of power to produce aluminum. So in that scenario, I believe that the market is going to remain fairly tight going forward. It's a very big market as compared to the copper. Copper is a very small market. It's 26.5 million ton, but aluminum is pretty big market. But even in this market, I think the supply side issue will persist, and the way US impose sanction on the Russian oil, I mean, if more sanctions are coming on aluminum, then what will happen to prices? So we don't know. These are the black swans, but even though these are under consideration. So aluminum from here, another 15% upside, very likely.
Let's come to zinc then. And when you look at the LME availability in sense of stocks, there seems very shallow, less than a day's requirement perhaps. But we haven't seen the zinc prices run as much until now. Is it the demand side that the street is waiting for?
Yeah, so in zinc, Chinese steel demand is trailing, and because of anti-dumping duty in even from India and many other countries and US, so I think the export prospects have dimmed in China, and because of that, the production is scaled back by the Chinese producers, and they are likely to stick to that. The major demand of zinc is coming from the galvanizing and if the demand of the steel from China is going down, or if they are cutting production, then zinc should not do well, and that is the reason why zinc has remained underperformer. So I expect the same trend to continue in zinc. There's nothing happening in the world which makes me believe that the steel demand is going to rise abruptly, except in the emerging markets, especially China, Indonesia, Vietnam, or perhaps a few African economies. Even in Europe, it is expected, but China, nothing is going to happen as far as the major demand growth is concerned. So I believe that it will continue to remain underperformer as compared to the other metals you recommended.
Point taken. So, Kunal, you've talked about the individual fundamentals here and why each metal will perform the way it will. But let's talk about macros now. Interest rate cut, decline in US dollar, tariffs, US and China trade conversations. There's plenty to watch out for, and the sentiment can play sometimes more than what the fundamentals do. So what is it that you're also watching in addition to all of these pointers, fundamentals for the year 2026?
So it's a very good question, Manisha, that what is the key macro? And key macro is only one thing, liquidity. So we are in a scenario where the debt levels of the developed economies are unprecedented. And next year also, those are going to rise. So how are they going to pay off their debts or service their debt going forward? They have to create new debt. That is how they've been doing from last 15 years. And there's no talk about fiscal consolidation, and it cannot happen, because if they do that, the economies will collapse. They will start going into recession, or perhaps even far worse than recession. So we have to understand the macro backdrop, and that clearly indicates that the liquidity is going to remain tremendous flow. And that's the reason why, in spite of all the negative news, all assets are rallying together, except gold and silver, which is corrected lately. But I believe that the liquidity conditions will remain pretty relaxed, pretty ease. US money supply M3 as an all-time high, and US topping its quantitative tightening program, that itself is one sort of QE, because every month they were pulling up $95 billion from their market, and now that is not going to take place from tomorrow. For example, they make an official announcement tomorrow. So 95 into 12, if you take it, so we are having $800 billion of liquidity chasing various asset class. So this liquidity is the prime reason, macro reason behind this bull run in commodities, may it be precious metals, may it be base metals, because so much money is being printed, okay, directly, indirectly. And I will not be surprised that even Bank of Japan falls back and say, okay, look, now forget about inflation. We need to print more, because that debt market has become absolutely illiquid. The bond market is becoming illiquid. So I think it's the major reason for me to remain bullish on the macro front is the liquidity conditions are going to remain quite robust, and that will chase commodity prices and commodities.
Point taken, Kunal. Thank you so much for joining in. So the liquidity conditions are high, more money printing is happening, all asset classes are rising. And as Kunal points out, 2026 is the year of base metals, and that's exactly what we already are working or looking into. Welcome back. You're still with us at the Big C, and the topic of discussion now is going to be the energy markets. There's plenty happening in sense of headlines there. On one side, you have those sanctions coming in on Russia from US and, of course, from the European Union as well. On the other side, you have the OPEC, which has talked about increasing production going forward. Let's put all of those questions to Mr. Mukhesh Sahdev. He's founder CEO at Xanalysts. Mr. Sahdev, hi, thank you so much for joining in. First of all, your sense on the sanctions that we've seen happen on Russia. Most markets believe that, as always, and after all of those sanctions as well, the Russian oil would be available to global markets at large.
Thanks, Manisha. Good to be back on the show. I'm right now in Hyderabad attending the Energy Technology Meet. So been meeting a lot of the senior folks in the oil industry in India. My sense on the sanctions is that the official stated position is that now India was asking the US that if you don't want us to buy the Russian oils, put us the sanctions. Now we have the sanctions, so I think the sentiment and the official news that has come out is probably curtailment of those barrels. Now you're right in saying that doesn't mean the barrels will disappear from the market. I guess China remains a wild card on taking those barrels into their system. But one key point I want to point out that this is not going to cause a sudden shock in the market. And the prime reason is that India and China have been actually buying a lot more barrels September is a month compared to August where the imports usually don't rise. But this year we have seen some good rise in the imports. So India has been buying steadily the Russian barrels so far, but India also increased the purchases from the non-Russian other sources. So in some ways, I guess India and China both expected that one day the sanctions are coming, and they have come, and they had already prepared for it. And that preparation is what will not lead to any big price movements or shocks. I can touch upon how Indian refiners are preparing for those kind of things a bit later.
Oh, we can go to that directly right now, Mr. Sahdev. What is it that you believe that is going to be? Because for the longest time, the global headlines also have continued to say on how US has only penalized India for buying and not other countries. And yes, as you said, the reaction has come in. Indian refiners perhaps are looking at other sources. India does import from nearly 43 countries therein. Small quantities, but do you see those quantities kind of increase? And where do you see India sourcing it on a bigger way?
Well, as you pointed out early in your question, OPEC is always there. That's number one. India has been a traditional buyer, a lot more barrels from those Middle Eastern nations. And there was a time India didn't used to buy Russian oil. So this is nothing new from that perspective. The second point I would say is that the Indian refiners are probably getting ready for all kinds of scenarios when this crude is not available. A lot of permutations and I would say modeling at the moment of scenarios is happening, how they will use the different assets. Now, India, the news is out there and the numbers out there that India has stepped up some higher purchasing of the US WTI barrel. So that's definitely one way to increase. But of course, OPEC is also going to bring the barrels back, and that might help the situation. And as I said, India had already bought ahead of these sanctions in advance. So India has options. I don't see a panic. I didn't see a sentiment of panic. I think for now, there are a lot of details to be also worked out in these sanctions. And you never know when it comes to the US president, things can change. And let's wait for what happens with the US-China sort of a situation that might have implications for India as well.
Well, that's about India. I also want to talk about the global markets therein. And just going back to my first question, that Russian oil usually has found markets in the global strait there. What is it that can impact? We understand there are some tankers, some companies which do not come under that sanction. Do you see those kind of loopholes perhaps being explored?
Great question. And short answer, yes. Russia is not Iran, where you put sanctions and then let a big producer, a big refiner go out of the market. I don't think that is what the US president or anybody is preparing for. So that's one point. So yes, Russian barrels will find ways out. And we have seen how Iran has done it for years, and Russia has probably learned those techniques. I don't know what those methods are, but certainly I'm not in the camp that this will mean Russian production or Russian will get choked supplies. So Russian barrels will flow. Yes, 500,000 barrels per day, 600, 700, those kind of numbers. But those numbers can be easily replaced in the short term from the stocks. We also know that China was already preparing for possibly this kind of a scenario. And for this year, China was buying almost 10% more than their refinery needs. So I think the oil stored in these systems will come to sort of rescue. And we also know that the floating storages on oil have also increased. So yes, there is a lot of oil already floating around for any temporary shocks. And before you know, there might be another big headline where things can change on the US-Russia sort of a situation.
When you come look at the global markets therein, with whatever has been happening, we've seen crude oil prices quite range-bound, quite restrained in that sense. That is because the markets are working with enough supplies, availability, even spare capacity with the OPEC and its allies. Do you see this scenario continuing to play out? And that is what will keep the crude oil prices in check?
Yes, I think you point rightly that typically in other times we would have seen a much bigger price reactions. And why don't we see those reactions now? I think the short answers are one, on the supply side, the geopolitical tension is a norm. In the past, probably people were not anticipating a lot on the geopolitical side, so they were not prepared. But now everybody prepares for geopolitical sort of situations. And so when those things happen, the prices don't move. That's on the sentiment side. On the fundamental side, I would say that you're right. There is spare capacity in OPEC, which helps. There is enough stored barrels in China, which helps from prices going high. On the prices falling down, yes, China's stocking up India's purchase ahead of these sanctions, and some of the geopolitics will not let the oil price go down. Also on the product side and the crude side, the US data on the Cushing side has become less relevant these days. I know from my days in US that Cushing numbers and US stock numbers were very relevant, but we have seen in these times those numbers have become less relevant. So yes, week on week we might hear news. Now we are anticipating some news around draws in the US side. So these news might help. But overall, I think this is the range, will not fall below 60 for long. And I don't expect to go much higher either. That's how the oil market will play out for some time.
When you say 60 is a support, would you say 70, 72 is perhaps a resistance?
Yes, I think that's a good band to play on. And the big thing to watch is the US-China sort of a situation. And I would say that US and China truce could be a good news for India. Let me give you one example, and this is a theme of the Energy Technology Meet to talk about a lot of petrochemical side of the market. China has been a big buyer of the feedstocks from the US, a lot of the NGLs, the propanes, which have been going into the petrochemical system in China. If the truce doesn't happen, and if those flows which are now curtailed do not go back to the old levels, China might come back to the market and buy from the Middle Eastern side, which is the traditional place where India buys its LPGs and kind of lighter molecules. So China-US deal happening is actually good for India. If that doesn't happen, China goes and buys from the Middle Eastern market. It's not easy for India to get access to those molecules from the US from multiple dimensions. So I guess a lot needs to watch on what happens with US and China sort of a situation.
Oh, that's an interesting point you make. A final question then, Mr. Sahdev, and this one really is in the OPEC. And while we've heard from them that they might be looking to increase production, how much, by when, and the impact on prices that you see?
Yes, I think now it's probably not a big news to say OPEC will bring back or OPEC will cut. I think they are on a trajectory, they are on a path to bring the barrels back, and not just barrels back. What has big thing that has changed is it's not the supply to the market. A lot of the barrels I've been talking around go to their refining systems, and that's how they consume some of that crude. So even if there is a news around the OPEC barrels coming back, I don't see big numbers. And why I don't see big numbers to be announced, because the backwardation in the market is thin. It was flirting with contango, and like last time I shared on the show, contango is one thing which OPEC certainly doesn't want market to go into, so they will guard against it, even if they can accept some lower oil prices. And we have seen that the backwardation was quite thin, so I don't expect some big numbers to come out. And even if those numbers are, those are not the barrels that will make it to the market so easily. So that is where I see the oil price staying supported, despite the OPEC announcement.
Makes sense there. Mr. Mukhesh, as always, thank you so much for joining in and making sense of all that's happening within that space of energy. Appreciate your time, as always. With that, that's all the time that we have on this edition of The Big C. Thank you for watching.